Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me is Jason Dehni, founder of Credbull, and Alex Dolesky, founder of Uranium Digital. We're here to discuss the benefits of tokenization for assets like private credit and commodities. Gentlemen, it's great to have the both of you with us. Welcome to Trade Talks, and let's give a more broad definition, Jason, kicking it off with what is a real-world asset and how do these relate to tokenization?
Sure. Well, thank you for having me, Jill. The best way to describe real-world asset is to first describe what it's not. So it actually is very distinct and different from what we know to be crypto. Most people think about real-world asset in the context of crypto, but it's quite different. It's not Bitcoin. It's not Ethereum. Those coins tend to have a utility within their ecosystem. They tend to be speculative, or they tend to be a store of value. Real-world asset, it represents an intrinsic value of an actual asset off-chain, whether it be financial or otherwise, that has intrinsic value and that is tokenized into a fractional ownership and placed on-chain. Now, why would that, be necessary? By tokenizing an asset, you are creating much broader operational efficiency across the entire investment cycle. You're providing greater transparency to the underlying asset and how it's managed, providing liquidity, as well as increased access. You are bringing the size of the investment, in the case of private credit, for example, from 500,000 down to 5,000, depending on the asset class. So it addresses fundamental problems that we have in traditional finance. And by placing it on-chain, you are addressing a lot of those issues. I would say probably 2/3 of them are being addressed today, but we still have quite a ways to go to kind of get to its full adoption.
Right. So, Alex, when I hear intrinsic value, the first thing I think of is a derivative. Would you say that tokenization is akin to a derivative? And then continue on more with the conversation of what the benefits are relative to the way that, real-world assets are available today.
So thanks for having us. I think of a derivative as a layer on an underlying, basically a financialized layer on top of an underlying asset. So when I think about RWAs and tokenization, I kind of think about it in the inverse, i.e. you're taking away a layer of access and effectively democratizing access from users directly to the underlying. In the private credit sphere, I'm sure Jason can talk about it more extensively than myself, but you have a multitude of different structures, rehypothecations, all sorts of things that create a situation where for the average consumer in crypto, and I think as well as you see that consumer landscape expand to people who are either new to the space or coming from a traditional financial background, to offer these kind of options for their own diversification on chain, hold a lot of value, have a huge amount of growth potential, and at the same time, already have these existing markets, you're effectively tapping into a new consumer base to access.
Right. So, Jason, tell us about Credbull and why tokenization for the private credit space.
Sure. So, Credbull is essentially a decentralized asset manager. We specialize in private credit, and within private credit, specifically in SME lending or small and medium-sized enterprises. So we manage the first licensed on-chain private credit fund in a highly diversified manner. So we allocate capital to some of the largest fintechs in the Middle East, Southeast Asia region in a highly diversified way. And we offer high fixed yield products, such as 10% fixed, 30% participation in the performance of the fund. That's non-correlated to the rest of the crypto market. So we are an institutional grade real world asset that addresses a very particular need. Now, why private credit in particular? So private credit has been traditionally for the last 20 years, one of the best performing asset classes on an absolute and risk adjusted basis. But private credit has also come under a lot of scrutiny and criticism for the last few years. One, it's a highly exclusive asset class. To get into a private credit fund, you need typically a minimum of $1 million and you're locked in for 4 years. So generally it's 4 + 4. It's also highly opaque. It's been criticized as the underlying, there's mispricing in the underlying assets that it deploys credit in. So, particularly in small ticket private credit or in private equity or corporate debt. By placing private credit on-chain, you're taking the veil off of how private credit is managed. So it's more than just tokenized fund. It's truly decentralized fund management. And and this is kind of the point that a lot of people miss, is that they think of tokenized fund as simply a way to operationalize or stream the operational infrastructure of the fund. We take it a step further to make it decentralized, which in a sense it creates a full transparency in how we allocate capital off chain 3 degrees out, where all that data, whether the kind of the capital deployment at the originator level, at the product level, and all SMA transactions are placed back on chain and fully transparent to the investors in real time. So there's zero gap between the stated strategy and risk controls and how we actually allocate capital, which today does not exist in private credit.
Right. So, Alex, I would imagine the same applies to what you're doing with Uranium Digital. Tell us more about that and how tokenization for niche commodity markets helps to remove some of those inefficiencies.
Yeah, thanks. So a lot of what Jason discussed as applied to private credit holds true for commodity markets as well, specifically some of the more niche commodities where one can develop a thesis on several, particularly battery metals or renewable energy materials. These markets are, from a market structure perspective, very different than how you would know gold or silver or copper to function, i.e. you don't have a full futures calendar, you don't have a derivative stack on top of that. Really how these markets operate are directly between the actual end users of the underlying commodity and the miners or producers of it. So that creates a few issues. Primarily one, as an actual, you now basically have a very concentrated market, i.e. people can't trade in them very easily. You don't have financialization like you know it for other commodities. So effectively tokenizing some of these specific niche metals, uranium in particular, this is a market that has no actual futures calendar. It's got no options board. It creates a very difficult situation for both utilities and users of the commodity, whereby if you think about a battery producer, for cobalt, they can basically hit the LME or the COMEX, roll out a futures calendar of what they need to take physical settlement for, and thereby both lock in the actual pricing of the underlying commodity and a reliable delivery schedule of it. The problem with uranium is that this market doesn't exist whatsoever. So this creates obviously an extremely difficult and different situation for utilities, for renewable plants, for anybody using the underlying material relative to other commodities. In addition to that, you have a very opaque market where there is not open pricing. What one has to do is apply themselves and basically do trades directly OTC with different converters, storage facilities, things of this nature. And furthermore, in the current investment landscape, the crux of any underlying commodity ETF or, for example, an RWA is that you have the ability to do both cash settlement and physical settlement. That's what keeps the natural arbitrage holding true, such that the price is always in line with the actual underlying asset. In the current landscape, there exists no options for both physical and cash settlement for a few of these commodities, and that's what we're hoping to solve.
So, Alex, is this infrastructure in place to be able to trade when it comes to tokenization, or are you still at the early innings of developing this?
So we're pretty much at the last innings of it, actually. We're going to be making some announcements over the course of this summer. These involve industry relationships because obviously for each of these commodities, you need a network for a project like that to succeed, which involves both the storage, both the physical settlement process outside of the financial and cash settled side, which is primarily executed through traditional market makers, as well as DeFi native market makers. The physical settlement side for these commodities is really the crux. And that's what we've been working very, very hard over the last year to actually accomplish. And like I said, we're going to be making some announcements over the next few weeks, pulling the curtain back on what the entire structure looks like, who's involved, and how we're going to go about accomplishing this.
Yeah, and Jason, that's what I think is interesting because the both of you come from traditional finance backgrounds and have made that switch over to the digital asset space. And I guess, removing that lens of thinking, okay, here's a market that's available. There's market makers that are able to supply the liquidity and keep the markets in balance. And I guess, when you think about your traditional finance background and where you are right now working through the tokenization process, explain to us, does it look similar? Is that in place for the private credit space?
Jill, that's a great question. So we get asked quite a bit about the user experience, particularly for institutional investors who are used to, deploying capital in a certain way. And even, this morning I was speaking to a large institutional investor from New York, and he's been having discussions with a number of tokenized asset managers, and he was frustrated with the user experience that he's had to date because of the complexity around getting MetaMask and having to buy stable coins and so forth. So the approach that we've taken is to simplify the entire user experience and meet the investors in a way that they're used to, rather than trying to get them to fit into the native crypto world. And that's really important for mass adoption. So, coming from that world, where having spent most of my career in asset management, wealth management, and private debt, you have to think in terms of what problems you are solving for the investor and how to simplify that experience for them such that you're removing the friction of adoption. We have enough friction with respect to the regulatory landscape and others that, anything that we can control to simplify that experience. I think it's incumbent on the industry to move beyond MetaMask and, holding, secret keys and, multiple secret phrases and so forth.
Yeah, I think that's a great point, Alex, that Jason brings up, especially when you are in the financial services space, where not only do you have the technology and the structure that needs to put into place, but I mean, at the end of the day, we are heavily regulated, we're globally regulated, and to be able to have a similar user experience, whether you're talking about the trade itself, storage, custody, whatever the case may be, it's really about the user experience at the end of the day when it comes to mass adoption. You can have all the technology that you want, but if you don't have the capital markets engaged, it's kind of like, having an EV without the power to move it forward.
Yeah, exactly. I mean, to create a solution to a problem that nobody really has doesn't really go very far in this industry, as I think there's countless examples of. I agree with Jason's point wholeheartedly, because to onboard institutional capital, you need to obviously reduce friction to onboarding. And for that space, you obviously have a tremendous amount of it relative to what's structured in the traditional sense, both for participating in private credit funds or trying to trade different commodities. With that, though, the counterpoint to it is you need to match the same degree of reliability, trust, and actual insurability behind it. In the case of both traditional assets you're bringing on chain, you need an equivalent safety net for recourse, for what happens if something goes wrong, insurance, things of this nature. And you need to marry that with an actual digestible user experience that is both intuitive and at the same time, I think, reflects familiarity with what this existing sort of structure is, however, reflects that kind of trust, and at the same time is built in a way, architecturally speaking, that you have equivalent safety mechanisms in place, reliability, regulation, all this stuff. And on the front end, to have this kind of seamless user experience, that the value prop actually does exist for its usage, because at the end of the day in the RWA space, my opinion is, for a lot of these individuals and market participants, they're taking a bit of a leap of faith to dive into our space. So you need to give them an actual value proposition with what you're doing, either a problem solve, a user interface, ideally end to end, where it actually is a better both experience and product with equivalent and ideally better mechanisms of transparency, regulation, all that kind of stuff.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having us.
Thank you.